Previously, we have talked about current ratio, and we have compared the e-commerce companies in China and USA, such as Jingdong, Alibaba, Amazon, Weipinghui, and Pinduoduo. What about their new situations now? Let's do a quick update on that. This is their new situations now. We have known that the best range for current ratio is 1 to 2. This is a good range for them. And below than 1, we think is dangerous. And bigger than 2, we think not necessary. Now let's look at this one. For Shopify, it's too big. We think it's not necessary. Yeah, not necessary. And these are okay. Well, this one we think is not very good in terms of short-term solvency because it is below than 0. Yeah, we think that Pinduoduo looks very healthy in terms of short-term solvency. So do Alibaba and eBay. These are all okay, but these are a little bit lower, right? And then we have another concept together with current ratio. This is current ratio. We use current assets divided by current liabilities. However, in terms of current assets, there is one part that is not that current. That means its liquidity is not good. This part is called inventory. Because for inventory, we usually feel hard to sell them in market, convert them into cash in market without big discount or without a big loss in its value. So in order to measure the short-term solvency in a more accurate way, sometimes we remove inventory from current assets. Then we divide it by current liability again. So this new ratio is called the quick ratio. Compared to current ratio, quick ratio is more strict and more accurate in terms to measure company's short-term solvency. In this way, in order to evaluate company's short-term debt repayment capabilities, we usually use these two ratios together. Now let's look at the quick ratio of these e-commerce companies we have been using just now. For quick ratio, usually the best range is around 1. If it is too small, then we may reasonably think, this company may be difficult to repay for its short-term debts. If it is too big, then that is not that necessary as well. Let's look at the quick ratio of the e-commerce companies in China, US. We just changed here from current ratio to quick ratio. This is the results. We still find that Shopify is too high. It's too high. It's best around 1, right? Shopify is too high. These are okay, both okay. But Mercado Libre and Amazon probably is a little bit lower, and we may have warnings as well. Warnings. So this is for quick ratio. Topic 11. Let's analyze companies' financial situations. This time, we do not look at that from the quality of assets, but from shareholder perspective. Previously, we have looked at the company's financial situation from two perspectives. One is from the quality of assets. We use a ratio called ROA. And then we look at company from the short-term solvency perspective. We use two financial ratios. One is called current ratio, another is called quick ratio. And this time we have a new perspective. Okay, company's financial information from shareholders' perspective. And what ratio we will use this time? Our topic question here is how to look at the stock from a shareholder perspective. Shareholder here is investor. Okay. Now, we will use a new measurement here called ROE. ROE. Okay. I will explain ROE later, but here we have the ROE. How do we look at ROE? The bigger, the better. This is for ROE. Now let's look at these e-commerce companies in China and US. Here we have 2021, July the 1st. ROE literally means for companies' shareholders' equity. Still remember how to calculate shareholders' equity? It equals to company's assets minus its liabilities. ROE means for every dollar of shareholders' assets, how many dollars of net profits could be generated. So this is actually measuring the quality of company's equity. And company's equity belongs to shareholder. So if you were a company shareholder, you will be very interested in this part and how much capabilities to generate profits from this part. It will be very interesting. Let's look at it this way. Look at ROE. eBay is very high. That means for every $1 investors invest in this company every year, this year before last year, it can generate $0.911 net profits. Of course, net profits does not mean the dividends or the benefits returned to shareholders. Nevertheless, the higher the net profits, the more capability company has to give back to shareholders, right? And then we have Amazon. Amazon is pretty good. Jingdong. Yeah, Jingdong looks very good for ROEs. Then we have Shopify, Weipinghui. They are among the same level. Then we have Alibaba. Okay. Meili is pretty low. And Pinduoduo is negative. That means Pinduoduo, year 2020, it has a negative net profits. So that's why its ROE is minus. For ROE analysis, it's meaningless to analyze a negative ROE company, right? Usually we ignore this. However, this year Pinduoduo has a positive earnings, so situations would be different. Now let me explain ROE. Well, we learn from the cost principle of accounting. We know that this is the equation in accounting. Okay, this is assets, this is liabilities, and this one is the investment of shareholders. Okay. So for shareholders, they are very interested for every $1 of their investment, how many dollars of net profits would be generated. So in order to measure this kind of capability, we use net profits divided by owner's equity here. Yeah, this is called ROE. So ROE is pretty important in terms of shareholders' perspective. Now let's look at how to calculate and compare different companies' ROEs. We have this command already learned, compare snapshot. This command always compare the newest information between companies. And these are the companies we expect to compare. They include Amazon, eBay, Shopify, Mercado Libre, Alibaba, Jingdong, Weipinghui, and Pinduoduo. Okay, this is the measurements we use this time. Let's do it. Okay. Yeah, we will have the newest information. Oops, problem here. Yeah, we have been use a Chinese punctuation here. Let's change it to English. Now the command started to work. We will have the results very soon. And then we can compare the situation. Now we already have the results. Okay, it's pretty interesting. This is the newest date, 2022, July 25th. We find that eBay has a negative ROE. It means eBay last year, its net profits is negative. So it's meaningless to compare it here. Jingdong as well. Jingdong have a negative net profits last year. Right? The next we have, the biggest one is Mercado Libre. It's very interesting. This number means for every $1 that investors or shareholders invest in this company this year, it can generate $0.234 net profits. It's very strong. Then for Pinduoduo, we find out a very positive number here. It's very good for Pinduoduo. It's actually, in terms of financial situation, last year, 2021, is a turning point for Pinduoduo. Then we have Amazon, also pretty good. We have Weipinghui. We have Alibaba. Well, for Alibaba, its ROE last year looks not very good. Then we have Shopify. These are positive ones. Nevertheless, as a positive ROE is already pretty good compared to those with negative ones, right? Okay. We have a case study here, but we can do this as our module homework. Next, let's look at another perspectives. Let's look at some of the interesting financial analysis. We have some of the basic financial analysis here. First, we will have a profitability analysis, and then we will have a DuPont analysis. It's pretty interesting for DuPont analysis. And then we will have a growth analysis. For this part, we don't have much time to talk about them. If you are interested, we have the full version of the slides for Module 4. You can look at those corresponding slides by yourself. Of course, if you have any questions, you can still ask me. Now let's look at profitability analysis. Our topic 12, profitability analysis. Profitability analysis means we expect to evaluate the company. How strong is this company to earn profits, right? So this is our topic question. Let's compare this. I love comparative analysis because through simple comparative analysis, we can quickly find out which company is stronger, which company is weaker in terms of profitabilities. At this time, we use gross margins. Gross margins. In profitability analysis, we usually have a couple of interesting measurements. First one, we usually call gross margins. Gross margins means the margin before corporate income tax. This is very direct and useful. And by using this measurement, we can suppress the side effect of corporate income tax in different areas, even in different countries. And in this way, we can directly find out a company's real capability to generate margins. And margins means profits, right? So its advantage is to suppress the side effect of tax. So if you expect to reduce or find out the company's profit earnings capabilities, usually I suggest you to use gross margins rather than profit margins. So I think that professional guys use gross margins and non-professional guys use profit margins. Okay? Let's compare this. We find that for eBay, it's very strong for its gross margins. It's 75%. 75% is so strong. But why its profit margin is negative, I believe it's management fee or tax or some other factors. For Pinduoduo, it's pretty strong. Its profit margins is about 62.5%. 62.5%. It's very strong. For Shopify, Meli, Alibaba. Alibaba's gross margin is 41.3%. Amazon is 40.5%. VIP shop, VP weight is 20.9%. Jingdong is only 7.9% for gross margins. So sometimes we think why Jingdong's gross margin is so low, that lower than VP weight, lower than Alibaba, lower than Pinduoduo. I think it would be a very good topic for you to write an analysis report on this. Why Jingdong's gross margin is so low. Okay? But we still think Jingdong is a good company. Why? Okay, very good topic for you to write a short paper on that. Next, let's describe what is called a gross margin. So in order to talk about gross margin, we have to talk about typical corporate business costs. We have direct costs, and we have indirect expenses, and we have interest expenses and tax expenses. Direct cost means it's directly related in production and sales. Sometimes we call them the cost of goods sold, direct costs. For example, if we expect to make shoes, the direct cost is the raw materials to make these shoes, right? Indirect expenses in business operations, such as in production and R&D distribution, and blah, blah, some overheads. Still, we use the examples of making shoes. In order to make shoes, okay, you have to buy machines, right? You have to hire workers. You have to do many other things. These are all indirect costs or expenses. And then interest expenses and tax expenses. Of course, in order to run a business, you need to borrow money. And this money generates interest expenses as well. Then, in order to run your business, you have to pay tax, lots of kind of taxes. And most important one is called the corporate income tax. Corporate income tax. It is based on companies' gross profits. Okay. To any company, the corporate income tax is the most critical tax. Then, how do we calculate gross margins? If we have sales, here it means revenues, minus direct costs and divided by sales. So this is called gross margin. So from the calculation algorithms of gross margins, we find that we don't use the indirect costs. We don't use the interest rate, interest expense. We don't use the corporate income tax. So this is the real capability that the company makes profits. That's why professional analysts, they'd like to use gross margins, right? They analyze the relationship between sales and the direct cost of the sales. And it identifies how efficiently a company is producing its products, providing its services. Efficiently here refers to earning money. Because the purpose of business is to earn money. A business cannot earn money, can cannot survive. This is for gross margin. And what for profit margin? So previously, we have sales minus divided cost divided by sales. This is gross margin, right? However, this is the ultimate margin controlled by the company. We still have to minus indirect costs, minus interest expenses, minus tax, then divided by sales. So this part, we call them net profits, right? And this part, we call them gross profits. And gross profits in accordance with gross margin. While net profits in accordance with profit margin. Okay. So profit margin is also meaningful for analysts because profit margin is a measurement that reflects too many things. Such as companies' profit earning capability, such as the business environment, the good or bad of a business environment, such as tax, right? And also reflects the labor cost as well because it contains overheads. So many things like that, especially the indirect things. So it also reflects the management capabilities or the efficiency of a company manage its business, such as cost control. Now let's look at the case script we have. These are still the companies of e-commerce industry in China and US. We want to compare them. This time, we still use the command compare snapshot. This time we use a new measurement called gross margin. Of course, we can change it to profit margin, right? Margin. Of course, we can update that quickly. For example, gross margin here. This time, first we don't need it. Then we will consider to use this option. Otherwise, we don't need to take care about that. The command will handle this automatically, but sometimes the command is not smart enough to make everything in perfect situations. We are going to have the results. Okay, it takes time. Probably this time I need a quicker computer. Right? We can check to profit margin as well. Okay, we already have the results. Profit margin. Okay, we'll do that later. Let's look at the newest situation of gross margins of this e-commerce company in China and US. We still have eBay, which is very high this year, right? It's about 73.4%. It's pretty high, right? And then we have Pinduoduo. I was impressive about Pinduoduo's gross margins. 70.6%. It's pretty high. Alibaba is only 36.8%. And Jingdong, 7.4%. This is gross margin. Well, if we deduct by indirect costs, overheads, and interest expenses and tax, Jingdong become negative in terms of its margins. Let's look at this one. If we look at profit margins, eBay is marvelous. Its profit margin is 113.3%. It's pretty high, right? And Pinduoduo is 13.9%. It's still very good. Alibaba is 7.7%. Okay, while Jingdong is -1%. Weipinghui is 3.7%. Okay, this is the situation here about profit margins. Now you can compare profit margins and gross margins of a company and then write a small paper, discuss why some company is good for the relationship and some company is not very good for the relationship between gross margin and profit margins. There are lots of things to say in this topic. Dubang analysis, that is another very interesting topic. Okay, first, why do we do a Dubang analysis? Second, how do we do it? So the purpose of Dubang analysis is actually look into a company from shareholders' perspective. So from previous topics, we know that shareholders look at ROE, right? But you may have a question, why some companies' ROE is higher while other companies' ROE is lower? Why? What are the big factors to make one company's ROE higher, another company's ROE lower? So we need to separate ROE into several key factors in order to find out what makes a company's ROE higher, what makes a company's ROE lower. So we need to split ROE into several key factors. So usually we split ROE into these key factors. So this is ROE, right? And shareholders look at ROE. And then first, let's split ROE into two parts. This part, we call them company's financing policy. We use 1 divided by equity ratio, or it is actually assets divided by equity. Equity means investors' investment, and assets means equity plus liability. So company use liabilities as the leverage of owner's equity in order to make assets bigger. So that's why we call this company's financing policy. Because if a company is willing to borrow more money for same equity, it will have bigger assets. If a company is very conservative in borrowing money for same equity, its assets would be smaller. This one reflects the factor of company's financing policy. And then we have ROA. And we can further split ROA into another two factors. One is called company's operating performance. So this way, we use net income divided by sales. So actually, this is our profit margins, right? Profit margin. And then we can have another factor, it's called assets turnover. Asset turnover, we use sales divided by assets. So what does asset turnover measures? Suppose we have $1 of assets. Okay. In order to generate sales within 1 year, how many times of sales can we generate? For example, we have a machine, a shoe making machine. In order to make one shoes, for easy calculation, let's say every day one shoes can flow over these assembly lines. One shoe every day, or it's too small. For example, we have 200 shoes every day to go through the assembly lines. So if we don't have a rest for a year, every year these assembly lines can generate 365 batches of shoes. Every batch we have 100 shoes, right? So this one is called the assets turnover. So the higher the asset turnover, we use same assets can generate more sales, right? Okay. Suppose we have only one shift for this assembly line every day. Then for every year, we can have 365 batches. if we have a night shift, this means 2 shifts a day. How many batches can we generate? We can have 365 times 2 times 100 shoes per batches, right? However, if we have 3 shifts a day, that means how many batches do we have? We will have 365 times 3 times 100. That means the more shifts we have, the higher asset turnover we have. Of course, we need to protect our workers by law, by labor law, for 3 shifts or 2 shifts. So from this split of ROE, we find that 3 key factors. First key factors, company's financing policy. If a company is very aggressive in its financing policies, its ROE would be higher, right? However, on the other side, if a company is too aggressive in its financing policy, it may go bankruptcy. It may cause financial distress, right? Financial distress. So there are pros and cons for a company's aggressiveness in terms of its financing policy. First factor. Second factor, if a company is very efficient in managing its production lines, it will have higher ROE, right? So usually many companies, in order to escalate its efficiency, they use 996. Well, some companies maybe use 007. It's terrible, right? However, the purpose of this is to escalate the company's operation efficiency. And then for operating performance, that means if a company is higher in terms of its operating performance, its ROE will be higher. And if all these 3 factors are higher, ROE will be higher, and the shareholders will be happy, right? So this is the purpose of DuPont analysis. Again, let me summarize. The DuPont analysis, or sometimes it's called DuPont identity, is to find out why a company's ROE is higher or lower. Now let's have a 10 minutes break.